Welcome! Today we are diving into how to use the volume profile for intraday trading. If you have ever wondered how to spot key levels during a trading session, you are in the right place. By the time we finish today, you will have a solid understanding of how to use the volume profile to make better trading choices all throughout the day. Stick with me because we are going to cover everything from setting up the tool to using it for entry and exit points, and even avoiding some common mistakes. Let us jump in. Imagine having the power to see exactly where traders are making their moves, where the battles between buyers and sellers are fiercest, and where the price is most likely to turn. That is what the volume profile offers you. A true insider's view of the market dynamics that shape each trading day. To start, let us talk about what the volume profile really is. The volume profile is a powerful tool that helps show where the most trading took place at specific price levels during the day. If you are an intraday trader, this is especially important because it helps you see those key support and resistance levels. Think of it like being able to peek behind the curtain to see where most of the action is happening. It is similar to how certain chart patterns can help you predict potential price movements, such as head and shoulders, double tops and bottoms, triangles, flags, pennants, and wedges. Each of these patterns tells a different story about market psychology. For example, a head and shoulders pattern might indicate a reversal is coming, typically after an uptrend, suggesting a bearish turn. The head represents a peak higher than the two shoulders, signaling exhaustion in buying pressure. Meanwhile, a double top is another reversal pattern that occurs when the price reaches a high point twice and fails to break through, indicating resistance. A double bottom is the opposite, showing support, and often signals a potential bullish reversal after a downtrend. Triangles, which can be ascending, descending, or symmetrical, are powerful indicators of breakout potential. An ascending triangle usually indicates that the price is likely to break out upwards as buyers push the price higher against a flat resistance level. A descending triangle suggests potential bearish breakouts, while a symmetrical triangle can go either way, depending on where the breakout occurs. Flags and pennants are continuation patterns that form after a strong price movement. A flag looks like a small rectangle that slopes against the previous trend, while a pennant appears as a small symmetrical triangle. Both indicate that, after a brief pause, the price is likely to continue in the direction of the preceding trend. Wedges can either be rising or falling. A rising wedge generally indicates a bearish reversal, especially in a downtrend, while a falling wedge indicates a potential bullish reversal. These patterns form as the price action becomes more constrained, suggesting an impending breakout. By understanding these chart patterns and how they form, you gain insight into market sentiment and potential turning points. Imagine how useful it would be to combine this knowledge with the volume profile, giving you even more insight into where prices might go. For example, seeing a head and shoulders pattern near a key high volume level on the volume profile could strengthen the signal that a reversal is imminent. Similarly, a double top or double bottom near a significant volume level can be a clear indicator of potential reversals. If the price forms a double top near the point of control, it signifies that sellers are overwhelming buyers at that level, creating a strong resistance. On the other hand, a double bottom forming near a value area low can signal a strong support level where buyers are stepping in. You can also look for triangles, wedges, and flags alongside the volume profile. An ascending triangle forming near a high volume support level can indicate that buyers are gaining strength, and a breakout to the upside might be coming. Conversely, a descending triangle near a high volume resistance area may indicate that sellers are becoming more dominant and a breakdown could follow. Wedges provide additional insight when combined with volume. A falling wedge near a value area low, accompanied by increasing volume, can be a powerful bullish signal, while a rising wedge near the value area high may suggest a bearish reversal is approaching. Flags and pennants, which are continuation patterns, become even more reliable when they coincide with volume increases around important levels, indicating that a continuation is likely once the pattern resolves. By understanding the volume at key price levels along with these chart patterns, you can make much more informed trading decisions. When you notice patterns such as head and shoulders, double tops or bottoms, triangles, or wedges forming at significant volume levels, the signals they provide become more reliable and actionable. Does that sound like something that could help you? Imagine knowing exactly which price levels have a lot of interest from both buyers and sellers, and being able to connect that with recognizable chart patterns to make more informed decisions. Now let us set up the volume profile on your trading platform. Most platforms have this feature built in, but you might need to tweak a few settings so it works perfectly for your style. Let us walk through it together. First, open up your trading platform. When you are there, go to the section labeled Indicators. In that section, you will find the option for the volume profile. Click it and make sure to select the right time frame that matches your trading style. If you like trading on a 5-minute chart, pick that. If you prefer a longer period, go with 15 minutes or whatever works best for you. Make sure that your volume profile is only looking at the day's trading session and nothing more. You do not want it to include past days or longer periods because that will make things more confusing. We want a clean, focused view of what is happening today. Got it? Once you have it set up, you will see bars along the price axis. The longer the bar, the more trading happened at that price. It is pretty simple but super powerful. Have you ever noticed how prices tend to linger around certain levels? Well, this is why. Let us dig deeper. The most important part of the volume profile is the point of control, which is often called the POC. This is the price level with the highest trading volume during the day. What does that mean for you? It means that this price level often acts as a strong support or resistance zone. If the price hits the POC, there is a good chance it will either bounce off or have a hard time breaking through. Another key part of the volume profile is something called the value area. This is the range of prices where 70% of the trading took place. The price often gravitates toward this area. Think of it like a magnet. Understanding these levels can be further enhanced when combined with key chart patterns. For example, if you see a double top forming near the POC, it could indicate a strong resistance level that the price is unlikely to break through, making it a potential point for a reversal or shorting opportunity. Similarly, if you spot a head and shoulders pattern forming around the POC, this is another indication that a major reversal could be imminent. The POC acts as a significant decision point for traders, and combining this with reversal patterns like the head and shoulders or double top increases the reliability of the signals. In the case of continuation patterns, a triangle pattern forming within the value area could suggest a breakout is coming, and knowing that 70% of trading occurred here makes it an even stronger indicator. Ascending triangles within the value area might indicate that buyers are gaining strength and a breakout to the upside is likely. Conversely, descending triangles could signal that sellers are dominating, and a downward breakout may be imminent. Flags and pennants are also critical to look for within the value area, as these continuation patterns show that, after a brief consolidation, the trend is likely to continue. Another useful pattern is the wedge. There are two types of wedges, falling wedges and rising wedges, both of which can provide significant clues about future price action. A falling wedge is typically considered a bullish reversal pattern, especially when it forms near the value area low. This pattern shows that even though the price is declining, the rate of decline is slowing down, indicating that sellers are losing momentum. If this is accompanied by increasing volume near the breakout point, it can be a powerful signal that buyers are stepping in, and a bullish reversal is likely. On the other hand, a rising wedge is usually seen as a bearish reversal pattern, especially when it forms near the value area high. In a rising wedge, the price is moving upward but within a narrowing range, which often signals that buying pressure is waning and sellers might soon take control. When this pattern is near a significant resistance level, such as the value area high, and is coupled with decreasing volume, it becomes an even stronger indicator of an impending bearish reversal. Wedges, whether rising or falling, provide valuable insights into the potential shifts in market dynamics. Recognizing these wedge formations alongside key volume profile levels can help traders spot potential reversals earlier and increase their confidence in executing trades. Additionally, paying close attention to volume trends during the formation of wedges can offer further validation. For instance, declining volume within a rising wedge or increasing volume during a breakout from a falling wedge helps confirm the anticipated move. Combining these chart patterns with volume profile insights provides a much deeper understanding of the market. For example, if a symmetrical triangle forms and the price is near the POC, it means that the market is in a state of equilibrium, and a breakout in either direction is likely to be significant. This can give you a heads up to prepare for a larger move. By learning to combine volume profile insights with common chart patterns, you can significantly improve your decision-making process and have greater confidence in your trades. Have you used these levels before to help guide your trades? Imagine knowing exactly which price levels have a lot of interest from both buyers and sellers, and being able to connect that with recognizable chart patterns to make more informed decisions. Once you have the volume profile set up, you will start seeing some interesting things about support and resistance. If the price keeps bouncing off a particular level with a lot of volume, that is a strong support or resistance area. The POC is one of those key levels, but there are also the edges of the value area. These are known as the value area high and the value area low. These areas often act as resistance and support too. Keep your eye on them as the day goes on. If you notice that the price keeps touching one of these levels, it is telling you something. Let us say you are ready to enter or exit a trade. How can the volume profile help you do that? Well, use it to find those key levels where there is a lot of trading volume. If the price is approaching a level with a lot of volume and is moving quickly, that could be a good chance to jump in. It is also helpful to consider chart patterns when deciding to enter or exit. For example, if you see a bullish flag pattern forming as the price approaches a high volume level, it could indicate strong continuation momentum, making it an ideal entry point. On the other hand, if a head and shoulders pattern forms near a high volume resistance level, this could signal a potential reversal, which might be a good time to exit. Similarly, identifying double tops or double bottoms near high volume areas can provide additional confirmation for exits or entries. A double top near a high volume area suggests the price may struggle to break through, making it a good point to exit or even consider shorting. Conversely, a double bottom at a high volume level can indicate a strong support zone, providing an ideal opportunity to buy. High volume areas are often where the price stalls, which makes them perfect for planning your exits. Exiting near these areas can help you lock in gains before the price turns against you. Combining the volume profile with chart patterns like triangles, wedges, or flags gives you a more complete picture and allows for more strategic decision making. Have you thought about using these levels and patterns together for your entry and exit points before? We can also combine the volume profile with other indicators to make it even stronger. One great option is to use moving averages. Moving averages are useful for identifying trends and smoothing out price data to help you see the direction of the market more clearly. If the price crosses above a moving average at the same time that it hits a high volume area, that is a pretty strong signal that the trend will continue. You could use a combination of a short-term moving average, like the 20-period moving average, with a longer-term moving average, such as the 50-period moving average, to generate even more reliable signals. When these two moving averages cross, it often signals a change in trend direction, which, when combined with volume profile data, can give you extra confirmation. Another good indicator to use is the Relative Strength Index, or RSI. This indicator tells you if the market is overbought or oversold. If the RSI shows the market is oversold just as the price is hitting a strong support area in the volume profile, that could be a perfect time to buy. Similarly, if the RSI is showing an overbought condition while the price is approaching a resistance level at a high volume area, this could indicate that a reversal is likely, and it might be a good time to sell or short the asset. Bollinger Bands are another helpful tool to use in combination with the volume profile. Bollinger Bands measure market volatility and provide a visual framework for overbought or oversold conditions. When the price touches the lower Bollinger Band near a value area low, and the volume profile indicates a strong support level, this can signal a potential buying opportunity. Conversely, if the price reaches the upper Bollinger Band near a value area high, it may indicate overbought conditions, especially if accompanied by decreasing volume. Stochastic oscillators are also valuable when used alongside the volume profile. Like RSI, they provide insight into overbought and oversold conditions, but are calculated differently. When the stochastic is showing oversold levels and the price is at a key support area identified by the volume profile, this can strengthen the signal to buy. Alternatively, when the stochastic oscillator shows overbought conditions near a resistance zone, this is a good signal that a reversal might be coming. There are many ways to combine these tools to enhance your analysis. For example, you could use the MACD moving average convergence divergence to identify momentum shifts in the market. If the MACD line crosses above the signal line near a significant volume support level, it is a strong indication that buying pressure is increasing. On the flip side, if the MACD crosses below the signal line near a high volume resistance, this might indicate that sellers are taking control. By combining the volume profile with these various indicators, you get a richer context for your trading decisions. Whether it is moving averages, RSI, Bollinger Bands, stochastic oscillators, or MACD, these tools help validate the signals you see on the volume profile, making your trades more precise and less risky. What indicators do you like using right now? Different market conditions call for different tactics. In a trending market, watch how the price acts when it pulls back to a high volume area. If the trend is strong, these pullbacks are often good times to jump in and continue in the direction of the trend. This is where chart patterns come into play. In trending markets, patterns like bull flags or ascending triangles can help confirm that a pullback is just a pause before the trend resumes. For example, if you see an ascending triangle forming at a high volume area during a pullback, it can provide extra confidence that the trend is likely to continue upward. In a range-bound market, you can use the edges of the value area to trade the range. Buying when the price hits the value area low and selling near the value area high can be a very effective strategy. Additionally, recognizing patterns like double tops or double bottoms at these levels can further strengthen your decisions. A double bottom at the value area low suggests that the price is likely to find strong support, making it an ideal buying opportunity. Conversely, a double top near the value area high indicates that the price is facing resistance and might be a good point to sell or short. Wedges can also provide valuable clues in these conditions. A falling wedge near the value area low may indicate a potential breakout to the upside, giving you an added advantage when planning your trades. Understanding these different patterns and how they behave in trending or range-bound markets can help you adapt your strategies more effectively. Does this sound like something you would want to try? Of course, there are some common mistakes that traders make when they are starting to use the volume profile. One of the big ones is focusing too much on the volume profile of just a single period. You want to make sure you are looking at multiple periods so you can see the big picture of what the market is doing. Another mistake is ignoring price action. Remember, the volume profile is a great tool, but it is just one of many tools. Always pay attention to price action to confirm what you are seeing with the volume profile. Have you ever made one of these mistakes? Another tip is to customize the volume profile settings. Many platforms let you do this. You can adjust things like the color of the bars, the size, and you can even filter out some of the low volume areas to reduce the noise. It is also helpful to understand how chart patterns can be emphasized by adjusting these settings. For example, by changing the color or thickness of the bars, you might be able to see a clearer distinction between important volume spikes that coincide with specific chart patterns like flags, wedges, or head and shoulders. If you are looking at a wedge pattern, adjusting the volume profile to highlight low volume zones can help you confirm whether the price is likely to break out. It is worth spending a little bit of time tweaking these settings so that they work well for you. A day trader might want shorter periods and more immediate feedback, with bright colors to indicate key volume areas, while someone trading on a longer time frame might prefer a broader view with more muted colors to reduce visual noise. By adjusting the settings, you can better align the visual representation of the volume profile with the specific chart patterns you are watching for. Take the time to play around with these settings and see what helps you see the market more clearly. In the end, the volume profile is a great way to see where the key price levels are, based on where the most trading is happening. It helps you spot support and resistance zones and can help you decide when to get in and when to get out of a trade. Whether you are trading every day or holding for longer periods, understanding how to use the volume profile will give you an edge. The more you practice, the better you will get at using it. So go ahead and start applying these concepts to your trades today. If you have questions or thoughts, feel free to share. I would love to hear how this works for you.